Let me just begin before I introduce this evening's event with a few housekeeping announcements. First and most important request is if you have a mobile telephone, an iPad, any piece of technology prone to make an irritating sound, if you could please switch it to event safe mode or switch it off altogether, I would be extremely grateful. Secondly, just to draw your attention to some upcoming events at the IEA. On the 9th of October, that's 2 days' time, isn't it?
It's tomorrow.
It's tomorrow. It's amazing how time flies when you're having fun here. We have an occasional lecture in this very room at 6:30 p.m, The American Civil War, A Classical Liberal View. And at the end of this month, on the 31st of October, we have a panel discussion in this room about the Bank of England, a new governor and new deputies. Do we now need a new approach to monetary policy? That's at 6:30 p.m. on the 31st of October, with a range of panellists: Tim Condon, Kevin Dowd, Andrew Lillico, John Mills and Andrew Sentence. Also, if they haven't been on your seats, you'll find these by reception. This autumn, the first has already happened. We have our series of Beazley lectures, which are about regulated industries. So if you'd be interested in coming to those, pick up one of those leaflets. On to the main action. We're here this evening to introduce you to, debate and discuss Iain Martin's fantastic new book, Making It Happen, Fred Goodwin, RBS and the Men Who Blew Up the British Economy. This book's already received rave reviews. Robert Peston of the BBC on the front cover describes it as a compelling account of Britain's worst ever banking failure. As you read, you will laugh, cry and fume. The book has been shortlisted for the FT and Goldman Sachs Business Book of the Year Award. The Financial Times says it strikes a very well-researched balance between nitty-gritty technicalities and readability. Its author is a good friend of the IEA, Iain Martin, well-respected and renowned journalist. He currently writes for the Sunday Telegraph, contributes pieces for the Daily Telegraph, Standpoint magazine and various other media outlets. And for the BBC, he's presented editions of What the Papers Say, Beyond Westminster, and appeared on Any Questions. And I think I saw you doing the paper review against Polly Toynbee just the other night.
I did, yes, yes.
We're going to ask Iain to introduce what he's said in the book for about 12 or 15 minutes. And then we've got three superb respondents. Firstly, Ian Allan, who is on Ian's immediate left. Iain trained as an actuary and worked for insurance companies in the area of fund management. He was head of strategy at RBS, working closely with George Mathieson and then with Fred Goodwin. And during this period, he was involved in all aspects of the group's activities. Because of his termination agreement, Ian's not going to talk about RBS specifically, but about the wider banking sector. And since leaving, he now practices as a visiting professor at Cass Business School. On Ian's immediate left is Allister Heath. Since Allister was appointed editor of City AM in 2008, its print circulation has now grown to around 100,000 copies a day and has become an enormously influential voice in London's business and political community. Allister, in addition to his unmissable daily column in City AM, also writes for a wide range of other publications, including the Daily Mail, The Sun, the Wall Street Journal, and The Spectator, where he also serves as an associate editor. The Telegraph, forgive me. Andrew Tyrie, our last respondent this evening, is the Conservative Member of Parliament for Chichester. Prior to entering Parliament, he was a senior economist at the European Bank of Reconstruction and Development. He's worked as advisor to successive Chancellors of the Exchequer, including Nigel Lawson and John Major. He is, of course, now the chairman of the Treasury Select Committee and also chairs a recently formed Parliamentary Commission on Banking Standards, which was established in response to the LIBOR rate fixing scandal. The Commission is examining the professional standards and culture of the UK banking sector. Please join me in welcoming our panel this evening. The way it's going to happen is that I'm going to ask Iain to speak for about 12 or 15 minutes, our respondents to speak for about 5 or 6 minutes. I'm not going to be completely rigorous on time, but if they start to overrun, I'll tinkle the bell and if you overrun enormously, I will start to ring the bell continually. So, first up, Iain.
Thank you very much, Mark. Thank you. Thank you for the very kind introduction, and thank you to the IEA for hosting this evening's event. Thank you all for coming up this evening. I'm not going to talk tonight in endlessly technical terms about hedge funds or CDOs or CDSs or all the rest of it. Some of you in the audience and some on the panel know that world far better than I do. I'm not a financial journalist, I'm a political journalist by trade. But I had to try and, in writing this book, the last 2.5, 3 years, I had to immerse myself in that world. But I had a bit of a breakthrough in terms of my understanding of what had happened and what had gone wrong when I realised, about halfway through my interviews, that many of the senior bankers that I was interviewing didn't know what these things were either. So your understanding of the financial crisis is aided a great deal if you accept that many of those involved didn't have the perfect handle on it. So at root, I'm a taxpayer who got very interested in what went wrong. And I think it's worth setting out at first just the scale of what happened and why it was such an extraordinary event. It's the biggest economic reverse, peak to trough, since the Second World War, and it's taking a period almost as long as that conflict for us just to get back to a starting point where we're beginning to see some half-decent growth again. Living standards have plummeted for millions of people, and the impact on the government's finances, we're all aware of that, but it's worth just laying it out. It's equivalent to a decent-sized war of national survival. If you think that Iraq, in terms of human treasure, it was obviously very costly, but in financial terms, the cost is estimated at about 10 billion. Well, I mean, we went into this crisis having taken a little more than 300 years to accumulate a national debt stock of just under 500 billion, and we'll come out of this eventually with having added about a trillion. So our children will still be paying for that for decades to come. So after the financial crash and the recession that followed it, I became fascinated by what had happened at RBS, particularly under Goodwin, because of all the banks, RBS was the biggest bank of the lot, biggest bank in the world, very briefly at precisely the right moment, and its rescue was bigger than all the others. So I wanted to try and find out, it's a fascinating human story, I think, I wanted to find out what on earth drove him and his colleagues, why was the blow-up at RBS quite as spectacular as it was, and in essence, what on earth did they think they were doing? Initially, it didn't really make sense to me. It didn't make sense to me how had this cautious bank that I'd grown up with in Scotland, respected institution, modest, that had been generous enough to give me my first small student overdraft, how had it turned into a monster that did so much damage? So I set out and interviewed as many of those involved as I could, but also wanted to expand it beyond that and spoke to regulators, officials, politicians who were involved at the time. And I also wanted to delve back into the bank's history, the origins of it. I think are really interesting. I think it can't really be understood without reference to the Scottish question, and why, if you want to understand why RBS became so big and why it grew so fast, I think you have to understand a little bit about its background. And it has its roots actually in the disaster of Scotland's attempt to colonise Panama in the 1690s. A guy called William Patterson, who had that scheme, who coincidentally was one of the founders of the Bank of England, which was set up to begin the national debt. And then after he'd done that, he wanted Scotland to reinvent itself and challenge England by founding an empire, which ended rather catastrophically. About a fifth of Scotland's national wealth was wiped out, and the Scots, a few short years later, ended up with the Act of Union. As part of the Act of Union, something was set up called the Equivalent Fund, turned into the Equivalent Society, which was to handle the compensation for Darien, because the English, in theory, hadn't helped the Scots or hadn't defended their colony when they might have done. That fund, in the 1720s, the directors of that fund said, well, we're doing quite well, we'd like to make some loans, why don't we turn ourselves into a bank? The Royal Bank of Scotland. So it has its roots in that incredible period, active union, Patterson, failed imperial hopes, all the rest of it. And I think it's worth understanding that pretty soon after that, the Scots were seen as pioneers in British banking, justifiably. I mean, they're almost 100 years or more than 100 years ahead of the English in terms of founding, of using joint stock banking. Innovators in terms of what we'd understand as the modern overdraft, affecting the cash credit system, all of that stuff. And the English were wary of this, of that innovation, particularly after South Sea Bubble, etc. But culturally, this had a huge impact in Scotland, and money had helped to make our reputation. We revelled in the idea that we were a country of great financial inventiveness, and the banks were the financial equivalent of what we were doing in terms of philosophy, science, economics, architecture, etc. I think it's important to understand that mythology about Scotland, by the 1980s, those great old Scottish banks are really struggling, RBS in particular. In the early 1990s, it comes close to actually making a loss. So its new leader, I mean, everyone talks about Fred Goodwin, but Fred Goodwin didn't start this story. Its new leader, George Mathewson, not a banker by trade, decided in the early 1980s that essentially RBS needed a complete revolution and modernisation. And where is it written, he used to say, where is it written that Scotland cannot have the best, stroke, biggest bank in the world? Sometimes he used the words interchangeably. A perfectly noble, patriotic sentiment. But by 1998, he wants to find a successor to continue that great patriotic work as he sees it, and alights on Fred Goodwin. First important point to make about Fred Goodwin, he's not a banker. He's a very smart guy, but he's not a banker by trade, he's an accountant, which requires a quite different mindset and a different set of disciplines. He'd only joined the banking when he switched from Deloitte in 1995 to join Clydesdale. So he was talented, bright, but someone with some pretty serious personality issues. As one of his team put it, he manufactured fear. At Clydesdale, actually, he wasn't a nationalist, but he was certainly a great, or is a great Scottish patriot. Goodwin actually hung a replica longsword of similar to the one that William Wallace used in Braveheart. Hung that behind his meeting room at Clydesdale. So together, Mathewson and Goodwin then have extraordinary success. They buy NatWest, which is an English bank which is much bigger than the Royal Bank, and in doing so they beat their age-old rival stretching back to the early 18th century, the Bank of Scotland. And it started to expand, this incredible expansion that Mathewson had talked about. Goodwin really put it on steroids, expanded into investment banking, expanded into Ireland, property, expanded everywhere it could. So it was essentially a bank that grew too fast and lent too much unwisely, and it went in about a decade and a half from being a modest Scottish bank with a proud history to being a giant. And the guy who ran it, not being a banker, was effectively focused on the wrong things. He wasn't focused on credit, risk, liquidity, capital, all those old-fashioned basics on which banking depends. He was more interested in building a great national monument or company. RBS would rival BP or IBM, or anything that could be shortened into 3 letters and could be painted on the side of an airport. So when RBS gets to the point of the crisis because of the ABN AMRO deal in 2007, autumn 2007, it has a balance sheet, total assets of 1.9 trillion conservatively. So that's a sum by that point bigger than the annual UK GDP. So when it falls, it's Britain's biggest ever banking collapse, it's Britain's biggest ever corporate disaster, and it cost 45.2 billion merely for us to buy the 82% of the Royal Bank of Scotland that the government owns in our name. So that whole tragic, technicolor, human story is told in my book, all the temper tantrums and strange obsessions, but that's enough about Gordon Brown. The more I looked into it, the more convinced I became actually that a lot of the explanations I was given were wrong or partial, that, or had been told before I started researching the book, and that it suited a lot of people, although Goodwin should carry a lot of blame, it suited a lot of people in the British establishment to say this is a story about one guy or a couple of bankers or a handful of bankers. But he wasn't, Goodwin wasn't a rogue trader like Leeson. He's not, he's not operating alone. Many others were culpable inside and outside RBS. So the blame in RBS was much more widespread, wanted to explore where the board had been, the regulators, all of that. And ultimately, who was the politician who said that we lived in an era of perpetual growth and that this crazy boom would go on forever. So I just want to draw a couple of lessons, I think, and observations that I'd be very keen to hear my fellow panellists' thoughts on and thoughts afterwards. First, I don't think this story can be understood without reference to the manner in which UK banking exploded and consolidated from the 1980s onwards. The blow-up of our banks did so much damage to the economy because they were so enormous compared to the rest of the economy. So here's what happened, and this I think is, there's only one chart for the economists amongst you, there's only one chart in the book, and I think it is, I didn't compile it, Richard Davis, brilliant young economist of the Bank of England, now of The Economist, compiled it, and I think it's the best chart of the entire financial crisis, I think, in UK terms. In 1960, there are 16 UK clearing banks, combined balance sheets, total assets, just £8 billion, which shows you how small the UK economy was then. So that's a sum equivalent to 32% of UK GDP. By 1990, it's 428 billion, that's 75% of GDP. So you've had the Big Bang, lots of people who didn't previously open bank accounts, didn't need bank accounts, had bank accounts, banking is growing, spreading, expanding. In 2000, it's 1.4 trillion, or 143% of GDP. So we've already breached, by quite some way, the the level that the Americans would consider safe or wise. I think their system sits at the moment at around 100%. And now this is before Gordon Brown gets to work. So here comes Gordon Brown and the end of boom and bust. Shortly after the crisis, combined UK bank balance sheets of the 5 clearing banks. So we've gone from 16 to 5, and 8 of those 16 are now inside RBS. Of those 5 clearing banks, combined balance sheets 6.24 trillion. That's 450% of GDP. Next observation, I think some organisations may simply be too big to manage safely. Even JP Morgan, which is very smug during the crisis about how it avoided the worst and how its risk management procedures were, in theory, brilliant and a model, even that ended up getting swallowed by the London whale when the crisis, long after the crisis, its bosses hadn't noticed a £6 billion hole in its trading book. So I think that mega banks, giant banks that span borders, may simply be too big to be efficient. Again, there's interesting research coming on this from the Bank of England and various other academics, and some work being done in America, which suggests a point which might sound obvious to us, but I think is central, that the efficiencies of scale of the mega banks may in the end really just rest on an assumption by those in the markets that if something goes spectacularly wrong, we as taxpayers will be there to pick up the tab. So we're told that the world will end if we do not have giant global banks, but when banking was in better proportion to the rest of the economy, say 20 years ago, was life noticeably worse. Next, I'd say much of the innovation in banking in the 1990s and 2000s has its origins in the early work of the hedge funds. First hedge funds, I suppose, arguably in the 1940s, but really get going in the 1960s. Hedge funds, of course, start as a way of making huge profits by using mathematical and computer firepower to outwit traders and beat the markets. So the techniques that they deployed, and remember those original best hedge funds in the US were often started by academics that just thought, I can do better than a bunch of traders shouting at each other and being drunk half the time. And the techniques they deployed then spread to banking. Creation of all sorts of new products and types of trades that the old banks would not even have attempted. Ways to securitize, new ways to securitize and slice and dice up mortgages and other debt, hedging instruments on foreign exchange risk, interest rate swaps, all of that stuff. So banking is becoming more complicated as it becomes bigger. I merely observe that many of these techniques data mining, excessive reliance on huge amounts of computer power, quant theory, probability, having been such a fantastic success in the world of high finance and helping to blow up the economy, they're now being applied to many other areas of our lives. It's how the large tech giants marshal and exploit information and data to make money out of us. It's even there in politics, in the way that, look how Obama campaigned, relying on computer power and those techniques just to harvest small amounts of votes in individual districts. Do that 200,000 times and you've won. You know, just focus on the numbers and harvest the votes. Don't, you know, forget about the arguments or ethics or arguments about the future of the country. Just do what the data says. So in this way, I think the theories that caused the financial crisis are spreading beyond finance. What could possibly go wrong? Finally, I think the biggest lesson from all crisis and from spending, say, 2.5, 3 years working on this book is about the constant need for healthy conservative, small c conservative scepticism. By that I mean simply, when it comes to running a firm or a country's economy, it makes sense to leave sufficient space for insurgent people to say this doesn't feel right, there's groupthink here, we have to be careful and responsible as well as being creative. So Fred Goodwin only got away with his atrocious management style, the bullying, the micromanaging in areas that didn't matter, and his lack of attention to the big questions, because the board let him get away with it. They failed catastrophically, along with the regulators and boastful politicians. So I conclude by saying mankind is wonderfully innovative and inventive, and will invent its way out of its, in the West, I think we'll invent our way out of our current difficulties. But we're also prone to manias and to hubris. If we make the oldest mistake, presuming we're so much more sophisticated than our predecessors, and forget that they have a lot to teach us, that's when we get into serious trouble. In the run-up to the crisis, people we should have been able to trust to behave sensibly made that old mistake all over again. Thank you.
Iain, thank you very much. Iain.
Thanks. As we said, I'm not going to talk about RBS, but since we're going to talk about RBS, some comments on the book, just some quick reflections. First of all, ABN AMRO. This was not just Fred or a Dutch bank. This is deal fever. Many of us know all about this. If you're buying a house, you think of the pros and cons. Whatever the framework, surely people doing something should be forced to write down what are their 3 principal risks. Not a risk factors, 100 pages. What are the main things? What due diligence have you done, and how would you mitigate them? CDOs, as Iain says, RBS clearly didn't understand CDOs, and they weren't alone. It's not a Fred problem. Citigroup, other banks, much the same story. The Parliamentary Commission is talking about a new regime for approved people. Andrew may talk about that. But whatever the framework, surely people must have the same competence as your doctor, or dentist, or teacher, or whatever. People must know what they're talking about. It's no excuse to rely on the regulations as Fred was doing. On the other point about Fred had not been in banking long. He had not lived through a recession, let alone a crisis. So I do like whoever he came from that the Parliamentary Commission mentioned, to have a historical perspective. There's somebody there, presumably someone fairly grey and past it, who's researched, looked at, been through, battle-scarred, to say, well, the last time it didn't work. Then there's the board, as Iain talked about. My experience, all these comments are based upon living through it. I think there's need for genuine diversity in boards, not just a few women on boards. Women on boards is good, but the point we see from Iain's book are, first of all, the board's willing to ask questions. I don't get it. How is ABN going to work? How do these CDOs work? In groups, people don't like to look silly, don't like to ask a daft question. And then it must be less of a tribe or a clan. You must have people who will challenge. So they could be people with a strong professional ethic themselves. It could be religious people, it could be academics, it could be think tank leaders who will not give in just for the sake of peace, but will challenge. And then these quick observations, the last one Iain raised was the size point. Having worked with George and Fred through that period, there is a big difference. The acquisition of NatWest was a great success. It was a very well planned and well done deal. But looking back, long before I heard about the phrase too big to fail. Working with George, one of my principal jobs was defence. Somebody might buy RBS, it was only worth 5 billion. For HSBC it was a snip. After buying RBS, you were too big to be taken over before you were too big to fail, and that was sad. So switching to a couple of points on the general framework. These are based on my experience, they're not academic analysis, they're judgment, like the judgment recorded in the book about my views of Airben Emerald and the CDOs. Where are we now in the journey? Have we learned lessons? Are things better? Iain's mentioned lots of guilty parties and some they ran through just now. For me, a guilty party not given enough punishment is the Basel regulations. Now I know lots of free time people like no regulations and bank just go bust, that's fine. But the Basel regulations do exist, they absolutely didn't work, completely failed to capture it. Since then, lots and lots of amendments, but it just adds to volume, complexity, more tick box compliance, less judgment. Lots of problems in them. Value at risk models, you do your own model and fiddle it, disclosures are limited, you know the issue. So I was pleased that the paper from the Bank of England last week on stress testing really moves away from purely tick box compliance and mechanical assessment of capital, more the thing I know from being an actuary, Solvency II, more requirement to do judgment and show judgment. Now I know many of you would rather have no regulation at all, but I think it is encouraging after 5 years of ridiculous things. None of you can tell me what stress value at risk, what it means. It's a silly formula. The paper of the Bank of England is a step towards a bit of common sense. You need some judgment, thinking and application. On the broader thing of standards and behaviour, as the FSA, RBS didn't break any rules. They didn't behave very sensibly. And Iain's book's all about the behaviour of Fred because it's interesting, or the management and the board and Gordon Brown and so on. So I found that having had this agonising experience through 2007, I found it really disappointing in the first phase that you had more rules or more proposed rules. The Turner Review, more regulation. The Walker Review, more governance. ICB, ring fencing, not silly, you know what they're getting at. But there are two main problems. First of all, a silver bullet, that'll fix it. Secondly, not understanding behaviour, particularly the ICB, which was quite thorough, refused to consider behaviour. Many people said it should be, but they wouldn't do it. They said it was not in the remit. I presume it wasn't in the remit. So I'm very pleased, although it's embarrassing to appear to stick up time and retire tonight, but I'm very pleased that the Parliamentary Commission was established, and compared to these failures or part solutions, that it really got into the behaviours that I had how many 100 miserable days that Iain's written up in the book to understand the behaviours that caused the problem. It wasn't the rules, it was the behaviours. And I'm pleased that the report focused on behaviour, and instead of having a silver bullet, according to the response from the government, had 114 recommendations, many of which are do further work. On the key point of interest to me about rules against ethics or rules against judgments and professionalism behaviour, I'm a little disappointed that it opted for regulation rather than professionalism, although I understand it's a bit like saying after library and so on is naughty children, so it's rules. Tea at 7, bedtime at 8, lights out at 9, that's it. But the report does hold out the possibility or encourages some development of a profession. For me, looking back at all this ghastly period in the book, the first requirement is understanding. You've got to know what you're doing, like any of us should in getting a bus or having a bath. You know what it's all about. Secondly, you make judgments. Now, you cannot make judgments if you don't know what you're talking about. RBS couldn't make judgments about ADM if they didn't know due diligence. They couldn't make judgments about the CDOs if they didn't know what they were. Then you have, having made judgments, you make judgments that are, I would say, ethical, but that's a bit religious. So let's just say responsible or appropriate or sensible. So that you need to understand the risks in the business and the risk models, and you need to have some framework of reference, a code of ethics or something. And then you need sanctions. I think we all need to know that if we are naughty, if we behave like Fred, we're a goner. I think it helps keep us all good that punishment exists in our life. Now, to me, these are the sort of things a profession would do. So I hope that out of the ashes, as Andrew said in a generation, not in 5 minutes, will come a movement to have less reliance on the rules and more integrity, more self-respect, more behavioural improvements. Finally, Iain, on the Christmas cards, Fred was right, they were rubbish.
Thank you. Allister.
Thank you. First of all, I think Iain Martin's written a really, really good book, a great book, and I think his analysis of what happened, his description and what he's discovered about the personality of the people is superb, and I highly recommend that everybody goes out and buys a copy of Ian's book. I'll just add to all that's been said now, and add a few reflections. The first is, I remember when I was studying economics, there's a particular financial economics course I was taking, and we were taught quite specifically that if a bank relied on the wholesale markets, it was obviously safer than if it relied on depositors for financing. Why? Because as we all knew, you could create clever models which showed that irrational depositors could suddenly take fright and run, and obviously the financial markets wouldn't, because they were liquid and global and big institutions and so on and so forth. So that was mid-90s. So it's just quite interesting, the degree of intellectual error that underlies a lot of these things, and it's also quite interesting how fashions change and perceived understandings of situations change. Another interesting point in all of this is the belief, I remember covering this as a journalist in 2005, 2006, you could almost find no mainstream US economist or analyst who thought that US house prices could ever fall in nominal terms. They looked back at the last 100 years of however long they had data, and they found that house prices never fell in nominal terms in the US. And you could have real terms declines possibly, but the nominal declines. If so, that meant that subprime lending was entirely riskless. You could lend subprime as much as you wanted because house prices, land prices would never fall. So even if the people defaulted, you could just seize their assets, sell them, and you'd be fine. And that's what they actually believed. Okay, people really believed that house prices couldn't fall in nominal terms. If you believed that, then all your CDOs were safe, right? Everything was safe, and you couldn't really have had the prices that you had. And again, that was a massive intellectual error, based on a number of things. I mean, one of the things, of course, was excessive reliance on past data, and various other problems of that nature, and the parochial nature of some of this analysis, because of course you had nominal price collapses in other countries and so on. But I think when you've got a situation where very intelligent people in academia, in politics, regulators, in banks, journalists, the public, authors, everybody believes a set of things, and the only people who don't believe them are very fringe groups on whatever side of the political spectrum, you're done for, basically. There's nothing you can do. There's just not enough. You just simply cannot smash this consensus, and that's why these kinds of consensuses are very dangerous. Another very interesting point is, in my view, is what kind of bizarre regulatory system is there that you have no plan B? You don't know what you'll do if something goes wrong. And that's basically what, in practice at least, if not in theory, you had with the UK banking system. Basically, you either had to assume that banks like RBS could grow and do what they did and would never go bankrupt, or you had to assume you ought to have had a plan of some kind to deal with a problem if ever there were one. And as we know, throughout history, there have been dozens and dozens, if not hundreds, of banking crises over the years. So basically, you had a system which basically said, either these banks do okay and everyone's happy, or something goes wrong, and oops, the world will end. We'll have to nationalise everything, and that's basically it. And unfortunately, it was the second of these two. And again, there's an academic link to all of this. I remember again as a student sitting in lecture theatres at first LSE and then Oxford, and being taught that you had certain situations where things would break down and the outside force would step in. You just didn't have an internal solution to the model, so therefore, under certain corner solutions or fringe outcomes, you need the authorities to step in and provide last resort insurance, as it was called, or something like that. So there was actually quite a lot of talk about all that. So what's really the answer? The answer is you need, in a capitalist system, you can have success, but you can also have failure. You can't have an economic system that's capitalist if bankruptcy is impossible or bankruptcy is made extremely, extremely difficult. In other words, if you genuinely believe that something's too big to fail, then you've got a massive problem, because you're saying that you're taking out bankruptcy and the fear of failure and the incentives of failure from the system. Personally, I don't think there's any institution, I don't think even a very large bank needs to be too big to fail. I think you can have very large banks, and I think you can devise mechanisms to allow them to fail. I think it's essential that that be done, and I'm afraid that even though the authorities all over the world tend to agree with that, and everyone's trying to work on this, and coming up with all these kinds of resolution mechanisms and new bankruptcy codes in effect to allow big banks to fail, I'm afraid they've not yet done that, which means if there were another massive crisis tomorrow, let's say the US government defaults on its debt next week, let's say they default for 1 day, 2 days, 3 days, 5 days, a month, and then everything starts to collapse again, I'm afraid to say we're just going to see the total nationalisation of everything rather than any proper resolution mechanism kicking into place. And so I think all the efforts ought to be now on that. And what's a resolution mechanism? It's basically saying that people made a terrible mistake a few years ago. They didn't realise, or they did realise, but they didn't derive the proper conclusions from the fact that, yes, it's quite easy to allow a corner shop to go bust, right? You can deal with it quite easily, but it's very, very difficult if a major institution like RBS went bust. If RBS had gone bust in the traditional way, the side effects would have been catastrophic. Maybe after 20 years, a lot of depositors would have got most of their money out, but that wouldn't have been too helpful for the rest of the economy. So what you need to do is devise a bankruptcy mechanism which can cope with the failure of RBS. You should not be devising a system which means that RBS will never go bust, and banks like RBS never go bust. If you do that, you're killing capitalism. You're just going to create a bunch of zombie giant banks that have got massive, massive amounts of capital and can never go bankrupt and always bailed out, and you're going to take out all the incentives from the system. You're going to once again have a situation where bondholders are convinced they'll always be bailed out, that interest rates would be too low, risk would be too low and underpriced and so on. So you need to have a system where failure is acceptable, but when failure does occur, it doesn't take down the whole financial system with it, and it doesn't destroy the middle classes and trigger a revolution. So I think that's basically, to me, that should be the #1 goal of banking policy. I think there's been far too much obsession with lots and lots of other things, some of them completely useless, some of them counterproductive, and the big one, make sure that banks can fail in a controlled and gentle manner, has not been sufficiently focused upon. There's another one, incidentally, that hasn't been focused on enough, is competition, and I don't mean artificial competition, I mean natural competition. In my view, you should have sort of a current account portability. In other words, make it very, very easy to change bank accounts, and that is a way to start triggering competition. That's a way to start getting Tesco and others to start grabbing market share, or new startup banks and others. That's the way to do it. Make the system more competitive in a proper market way rather than the top-down way. Okay, let's create another bank here. Let's hive off 100 branches here. Let's cap market share. So that's the wrong way to do it. So I think that's the other big reform that needs to take place. There's been some limited progress in that direction. You've got 1 week switching now, I think. But I wish that the government, instead of, the government's authorities have saddled banks with huge costs, some of them deserved, but I wish that one of the costs they had saddled them with was to create a new payment system which actually allowed this instant switching, and you had that cost rather than many of the other costs. Anyway, that's a few reflections on Iain's brilliant book, which I once again recommend that you all go out and buy a copy. Thank you.
Thank you. Andrew.
Well, thank you very much. Somebody sent me a free copy through the post, so I haven't got to go out and buy one. And I have read the most of the book, and it is a very good read. And as somebody, one of the preceding speakers said, it is the personal aspects of all this that are so fascinating, the characters involved that you've brought to life so spectacularly, and shown how they've interacted or failed to, and how what that's contributed to it all. There's so much that's been said here, which just now, which I agree with. I've been scribbling some notes on what I might add. I think, let me just pick up on just one point right at the start. Nobody said, oh well, this is all going to fail, or we ought to have some mechanism for dealing with regulatory failure if it turns. What's the plan B, as you put it? Actually, Howard and I were sitting in the Financial Services and Markets Bill for 18 solid months, and he will confirm, he better jolly well confirm, that we, on several occasions, forced a discussion in committee about systemic risk and its virtual complete absence from the bill and consideration of the bill. And we weren't the only ones. There was Peter Lilly out there also making points like this. There were a number of us who were already alerting people, trying to alert people, without us knowing where the crisis would come, having any idea at all.
And not to move responsibility from the Bank of England.
And absolutely, we're very, very cautious about that change. RBS failed for a heap of reasons, and most of them have been, some of them have been touched on. Everybody failed in this crisis, as in the crisis of HBOS as well. The board, the regulators, investment bank advisors, particularly on the ABN AMRO deal that played such a crucial role in its demise, auditors, credit risk rating agencies to a lesser degree, and the government played a very important role. Directly because they had got too close to RBS, and indirectly because they had created an environment, a regulatory environment, and a macroeconomic environment which was ineffective in the first instance and unstable with respect to the second. We on the Banking Commission have not tried to find a silver bullet. We don't think a silver bullet exists. We concluded too that whatever we did say, we should recognise that a bit of humility is required about the likelihood that we will hit on exactly the right reform that can take us to a much safer place. So we were arguing in that final report, indeed in all the reports we produce, for incremental change, incremental improvement on a wide range of issues. And maybe I'll just touch very briefly, in fear of that bell, on three. The first was on boards. The board of RBS was spectacularly dysfunctional, I think it has to be said, and your book flags that up. And that, curiously, but in a different way, we found was also true of HBOS. And we produced a report on HBOS which caused something of a stir, as some of you will know. We have considered whether the only way to solve this problem is in some way to do away with unlimited liability. Most of the history of banking actually has been an environment of unlimited liability. And there were fewer banking failures, and when there were failures, they were less systemic in nature, for the obvious reason that the directors came together, the partners came together when crazy ideas came before them and said, hang on a minute, this is my pension at stake, it's my house at stake, and that's when people get very jumpy indeed. We did not advocate going down that road, but we did take further some of the suggestions, structural suggestions, for placing more of a burden of responsibility on individual directors to think in that way. The interpretation of what we said on bonuses hasn't helped always in press coverage. What we actually said is that where risks are taken on the balance sheet, the reward structure should be aligned with the time horizon of the discovery of the scale of that risk. So if you do something, if you do a business deal in a bank that's got a 2-year horizon, you can get your bonus back in 2 years. But if it's very long term, you may need to wait up to 10 years to get your bonus. This we expected to cause, we expected that to generate a huge ruckus in the recently. But I can tell you that one a very large bank, perhaps our very best bank, immediately quietly told me that 10 years was too short and we should have made it 15. And that proposal, I hope, will become much more deeply embedded in the way boards remunerate their senior people. We need an environment in boards which can find room for what was described as insurgent thinkers, I think was the phrase. Absolutely. How do we achieve that? With great difficulty, but the role of the chairman is absolutely crucial. If you've got a good chairman, you can get it. If you haven't got a good chairman, however good the would-be insurgent thinkers are, they're unlikely to have the space they need to make the points they should be making at board level. The second area I'll just touch on is the regulators. We laboured heavily the point that we need to get away from mindless data collection and box ticking that's characterised the FSA, particularly in its later years, and the exercise instead of far more judgment. I don't think modelling is going to solve very much. In fact, probably not going to solve anything. Modelling largely requires econometrics, among other things. And I remember one of the world's greatest economists who never got a Nobel Prize, Iain Little, who died recently, who said to me, modelers and econometricians never proved anything. And that was even despite the fact that he'd often written a good number of books with a guy who did get a Nobel Prize and who was an econometrician. The third area, which I think we need to, we argue that we need to act on, was on this question of the proximity of the government to the banking system. One of our proposals, which the government has not picked up, and which the regulators in their responses, which they published last week, also neglected, was we argued that the Governor of the Bank of England should have a statutory duty to inform Parliament if, in his view, banks are lobbying in a way that is prejudicial to their job, to them being able to get on with their job. We all know that the banks got very close to a number of very senior politicians in the run up to this crisis, and we all know that when the heat gets on, they'll do exactly the same all over again. Somehow, we have got to bring downward pressure to bear on that, and we will be pressing vigorously as this bill, the banking bill, passes through Parliament for that proposal to get onto the statute. But you know, government does have to take a heap of responsibility itself, not just for the fact that this bank was too big to fail, that we weren't, in a regulatory sense, equipped to handle it. The fact is that the government the last government made three huge errors in the decade running up to this crisis. One was the removal of regulation from the Bank of England, which, however imperfect, had some credibility and generated some concern when the Bank of England got involved, whereas the FSA, they always thought they could game or fob off or handle with high-powered lawyers. But on top of that, they made two further massive mistakes, which we're still paying the price for. One is that they ran a deficit in the upswing. And as a result, we found paying for this crisis much more expensive than we otherwise would. And that has made the pain of bank failure far greater for the whole country. And the third mistake that was made, which is very important for us to bear in mind and really salutary, particularly for anybody who's read books like Kindleberger, Manias, Panics and Crashes, or Minsky, the underlying work on which it was based, is Labour were out there saying, and I don't mean to make party political points, but it was Labour making these points, we have put an end to boom and bust. If you tell people that you put an end to boom and bust, you instill complacency. And at that point, people will borrow more than they should, in the personal sector and in the corporate sector, as well as I just mentioned, in the government sector. That was a catastrophic error, which we're still paying the price for. Which brings me to my last point, which I've already articulated to some degree. We need to be humble about what we can achieve. And we need to be humble about the extent to which these reforms, when we have put them through, will actually deliver us the safety that we want from a systemic crisis. I am pretty much with Allister, actually, when he says we haven't yet solved the too big to fail problem. That is very much work in progress. I think, though, that they are still working on it, and my strong impression is that the Americans in particular are linking that to the issue of size. They want to find a way of regulating extra cost into great size on the grounds that economies of scale diminish for banking after a certain point. And I think that that's something, as we look at the structural issues ourselves, the ring fencing and the electrification of the ring fence that will go with it to discourage gaming of that ring fence, is something that we should bear in mind.
Thank you very much.